Hello. So for this module's assignment, I chose the topic of financial statement analysis and specifically focusing on horizontal analysis and how it can be used to evaluate the financial situation or the financial future of a business when looking to invest. So to start off pretty much with financial statement analysis, you're going to be looking to use this to evaluate the financial performance of the business. So obviously, if you are a lender or somebody looking to invest in a business, you want to be able to see how the company has been performing over the years that the company has been open, so that way you can see if it's worth investing in, or if you invest in it, if the company's going to fail, then obviously, you're not going to see a return on that investment. Best practice for financial statement analysis is to be able to analyze over data over a period of 3 to 5 years, so you can get kind of a more accurate feel for year over year the performance of the business rather than just first and second year. For horizontal analysis, it's specifically used to evaluate the business's performance year to year. So explaining a little bit more about horizontal analysis and kind of the calculations for that. So to kind of calculate the change from year to year, you are going to compute the dollar amount of change from the first year and the second year, or whatever it is, from the earliest year to, I guess, the highest year it would be. So from there, once you find that dollar amount of change, you are going to divide that by the earliest year's initial amount of sales. So taking those sales from year one to taking the sales of, the most recent year, and then that difference there, you are going to then divide that by the total sales of the earliest year, so like year one. In the case of entry-level horizontal analysis, I used the example if you are a lender looking to invest in an online boutique's new store. So an online boutique that's been open for 2 years and they're looking to open up like a brick and mortar store in their local community. So obviously a fairly new business. They only have 2 years of sales. So looking at this, year one, sales are $270,000, 500. Year two sales are $330,750. So we are going to subtract year one from year two to get the difference, which is $6,250. And then from there, we are going to divide that change in amount by year one sales, which were $270,500. From there, we are able to get the percentage change, which is 22.2% change in sales. So from there, the lender themselves can look at that and say whether that's worth investing in, just depending on if that's a high percentage of growth or a slow, if it's slow growth. They can evaluate from there if they want to invest. For mid-level horizontal analysis, I looked at a lender looking to invest in a second location of a large bar and grill. So very similar to an entry level. However, with this, I use it for mid-level just because the sales are a lot higher. So this is probably going to be a little bit larger of an investment for the lender. So year one sales were $785,000. Year two sales are $730,000. So a little bit lower than year one, so they didn't do as well. So when looking at this, we are going to subtract year one sales, which are $785,000, from year two sales, which were $730,000, and we're going to get negative $55,000. So they were behind $55,000 on their second year. So then we're going to divide that by year one sales, which were $785,000, and we're going to get a percent change of negative 7% change. So if you're a lender looking at this, obviously you can tell that sales went down. You may be wondering maybe why they're looking to invest in a second location. However, some other factors that you might want to look into are maybe some of the, like economic changes, some things that are going on, also demographic changes as well. So one thing that kind of I wanted to use in this example is that they may look at it and see that maybe it was a bad summertime. Maybe this bar and grill has a patio that brings in a lot of their business during the summer months, during the warm months, and maybe they didn't have such a good summer. Maybe it was very rainy or whatever it was, so that, affected their sales. So they can look at those types of things when trying to evaluate whether they want to invest in the second location. For the for the executive level, I chose another lender looking to invest, this time in the expansion of a chain fitness facility. So the fitness facility is they're looking to expand their current facility, maybe add on to it, some several thousand square feet. So for this one, I used 3 years of sales that we can look at. So year one sales, $850,000. Year two sales, $835,000, and year three sales, $960,000. So, as you can see, sales did decline in year two. However, in year three, they not only surpassed year two sales, but they also surpassed the initial year of opening sales. So, $960,000. So, what we're going to do again is we are going to take year three sales, which for the most current year, $960,000. We are going to subtract year one sales, so the earliest year sales, which were $850,000 from that. So we're going to get $110,000, which was the change between the two. We are then going to divide that by year one sales, which were $850,000. And we get a percentage change of 12.9%. So again, as a lender, you can look at that and kind of evaluate whether you want to invest in that expansion of the fitness facility. You may be seeing that there's a significant growth from year one to year three. Maybe from year one to year two, they were still trying to figure out kind of the ropes of running a fitness facility, and then finally in year three, they were able to really, use a lot of their resources and allocate their resources into the expansion of a personal training program. So they boosted sales in that, and that's why they're looking to expand their facility, because they need more space to use for personal training and coaching. So that's something that you can consider as well. For the ethics portion of it, I focused on just, a company lying about their sales. One reason why they might do this is, obviously they want to make their sales look better, so that way somebody would want to invest in their company. One of the verses from the Bible that I chose was, "The Lord detests lying lips, but he delights in people who are trustworthy." And I think this goes really a long way with, saying that while you may be looking to put money in your pocket by lying about something like this, at the end of the day, that doesn't hold well in God's hands or in his eyes. It really doesn't hold over well. And in the end, you're really going to be hurting not only the lender, but you're really going to be hurting yourself as well in that relationship that you have with God. So that is what I have for this assignment. Thank you.